Capital Protected Investments, or CPIs, are great for the safe money in your portfolio. They grow your money while at the same time guaranteeing your principal, and unlike bonds, their value is impervious to the ups and downs of interest rates. But it's only natural to wonder, how do they do it? Well, CPIs come in lots of flavors, and it's important to note that different investments do it differently. But one popular way of doing it is to use options. And the simplest way to explain options is this. Imagine you have a lake home with a spectacular view, but you don't own the adjacent property that is directly in line with your view. There isn't anything on the property now, but you're afraid someone might buy it down the road and build something that would obstruct your view. So you go to the developer who owns the property and offer him $1,000 for the option to buy the property from him for $200,000, which is a fair price, any time in the next 24 months. And he accepts. That $1,000 is basically guarding against him selling the property out from underneath you over the next 2 years. But suppose you learn over the next few months that the property has a gold vein running through it, and a mining company is willing to buy it for $500,000. Well, in that case, you would exercise your option to buy the property for $200,000, turn around and sell it for $500,000, and pocket $300,000. But let's say instead that you discover that the property is the nesting ground for an endangered bird, and the Environmental Protection Agency is stepping in and declaring the land a natural bird habitat that prevents anyone from ever building anything there. In that case, you would just let the option expire. Sure, you'd be out the $1,000, but you wouldn't have to worry about anyone building anything on the property ever again. The $1,000 option gave you the option of buying the property or passing on it. It was a way to protect yourself and your view. Well, if you do any digging and research options on your own, you're bound to see that options can be tricky and that you can lose money with options. So how do CPIs guarantee your principal? Well, the answer is that they're all hedging the options in some way. One of the simplest ways they hedge the options is to use interest only to buy the options. If you only use interest to buy an option on, say, the stock market, if the market goes up, you exercise the option to buy the stock market at the predetermined price, turn around and sell your shares at the new higher price, and pocket the gains. But if the market goes down, you walk away from the option. Sure, you lost the interest you used to purchase the option, but your principal is still intact, and you can do it all over again next year. That's how CPIs are able to guarantee the protection of your principal while still offering you the potential for growth. The growth potential of CPIs makes them ideal investments for safe money, but the ironclad safety of CPIs makes them ideal for retirement income ladders as well. In fact, many CPIs have income enhancements built right into them. Now, there are more types of income enhancements than we have time to go into here, but I want to quickly talk about how CPIs fit seamlessly into something called a Smart Asset Income Ladder, or SAIL for short. This is a SAIL plan for John and Mary Smith. John and Mary Smith are an imaginary couple with $500,000, and they need $2,000 a month in retirement to supplement their pension or Social Security. Now, this plan is specific to them, but it will give you an idea of how a SAIL plan works. Obviously, everyone's numbers will be a little bit different, and we have software that can show you exactly how this would look for you. But John and Mary are going to ladder their portfolio according to the numbers you see here. Asset number 1 is going to give them the $2,000 per month they need for the first 5 years. So they're getting reliable and predictable income for 5 years. But at the end of the 5th year, the money in that bucket is gone. Now, sometimes people worry and they say, well, wait, we're spending down our money. But look what we've allowed assets 2, 3, and 4 to do during those first 5 years. We've allowed them to grow. And look what they've grown to. Now we can use asset number 2 for our $2,000 per month income for years 6 through 10. We've been getting our reliable and predictable income now for 10 years. And during those 10 years, look at what assets 3 and 4 have grown to. We actually have more money than we started with, so if we wanted to, we could give ourselves a raise to offset inflation. CPIs are seamless fits for asset number 3 in a plan like this because they offer the ironclad safety That hedges against possible losses in asset number 4, which is typically money in the stock market. And they offer greater potential for growth than a CD or a bond, without the risk of losing value if interest rates go up. If you want to learn more about CPIs, or you want to learn about the income enhancement options that are available with CPIs, click the Schedule a Call button on the bottom of this email. A calendar will pop up where you can select a day and time for a quick 15 to 20-minute phone call. On that call, we'll walk you through how to determine the current value of your bond and bond mutual funds, and walk you through the different types of capital protected investments that are available to you. It's free, it's simple, and it's easy to get your questions answered. Just click the Schedule a Call button on the bottom of this email and schedule your 15-minute call.